Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. What would actually happen if the US dollar collapsed? Would global markets freeze overnight? Would international trade grind to a halt? Or would the global financial system slowly begin to unravel as investors lost confidence in the world's dominant currency? It's a dramatic question, but it's also one that appears more often today as global debt rises, geopolitical tensions increase, and some governments quietly begin exploring alternatives to the dollar-based financial system. So what would a dollar collapse actually look like? And how would it move through financial markets? Before we look at how a collapse could unfold, it's important to understand why investors are even asking this question. Several long-term pressures have been building beneath the surface of the global financial system. U.S. government debt has now climbed above $34 trillion, and fiscal deficits remain large. At the same time, central banks around the world have been steadily increasing their gold reserves. In fact, central banks purchased more than 1,000 tons of gold in both 2022 and 2023, the strongest accumulation in modern history. Geopolitical tensions are also reshaping trade relationships. Some countries have begun experimenting with regional payment systems and trade arrangements that bypass the traditional dollar network. None of these forces mean the dollar is about to collapse, but they do explain why the conversation is happening. And that raises a bigger question. Why has the dollar been so dominant for so long? Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. The US dollar sits at the center of global finance. Roughly 60% of global foreign exchange reserves are held in dollars. International trade contracts are overwhelmingly priced in dollars. And global banks rely heavily on dollar funding to operate the financial system. The US Treasury market also plays a critical role. At more than $27 trillion, it is the largest and most liquid government bond market in the world. Investors, central banks, and financial institutions hold treasuries because they are widely viewed as safe, liquid, and reliable. That trust is reinforced by several structural advantages. The United States has the world's largest economy, deep capital markets, and a legal system that international investors generally view as stable and predictable. In other words, the dollar's dominance isn't just about currency markets. It's about the entire financial infrastructure built around U.S. assets. But that leads to the next question. What would actually trigger a collapse? A sudden collapse of the dollar would likely require a severe loss of confidence in U.S. financial stability. That could come from several directions. One possibility would be persistent fiscal deterioration. If government debt continued rising far faster than economic growth, investors might eventually question the sustainability of U.S. fiscal policy. Another pressure point could be declining foreign demand for U.S. Treasury bonds. Foreign governments currently hold trillions of dollars in treasuries, helping finance American deficits. If that demand began to fall sharply, borrowing costs could rise quickly. There is also the possibility of slow structural change. Some governments are gradually diversifying reserves into gold or other assets, and several countries are exploring alternative payment systems outside the traditional dollar network. None of these trends alone would collapse the dollar, but together they could slowly weaken the system. So let's imagine the scenario. Confidence begins to erode. Perhaps foreign governments begin selling U.S. Treasury bonds more aggressively. Investors notice the shift. Treasury prices fall. Yields begin rising rapidly as the U.S. government struggles to finance its deficits. Now, the situation escalates. Higher interest rates ripple through the financial system. Borrowing costs surge. Financial markets grow volatile. At the same time, the dollar begins weakening in foreign exchange markets. Global investors start moving capital into other currencies and into real assets like commodities and gold. Commodity prices surge. Oil, copper, and agricultural products become more expensive. Because the United States imports many goods, those higher prices quickly feed into domestic inflation. In effect, the weakening dollar begins importing inflation into the U.S. economy. Financial markets would likely become extremely unstable as investors reposition away from dollar assets. And that's the key transmission mechanism. Loss of confidence leads to treasury selling, leads to rising yields, leads to weaker dollar, leads to higher commodity prices, leads to inflation at home. That chain reaction would ripple across the global financial system. But it's important to step back and look at the bigger picture. The dollar system is deeply embedded in global finance. International banking systems depend on dollar liquidity. Commodity markets operate largely in dollars. Sovereign debt markets rely heavily on dollar-denominated securities. Replacing that system would require far more than simply adopting another currency. It would require building an entire financial infrastructure capable of supporting global trade and capital flows. Right now, no alternative provides the same combination of liquidity, transparency, and scale. That doesn't mean the dollar will dominate forever. History shows that reserve currency systems can evolve. The British pound once held the role that the dollar occupies today. But those transitions tend to unfold gradually over decades, not suddenly overnight. If investors want to monitor the long-term stability of the dollar, several indicators are worth watching. First is the trajectory of U.S. government debt relative to economic growth. Second is foreign demand for U.S. Treasury bonds, which remains essential to financing federal deficits. Another important signal is the share of global reserves held in dollars. A steady decline would suggest central banks are diversifying away from the currency. And finally, investors should watch central bank gold purchases, which often reflect efforts to hedge against currency instability. Together, these indicators provide clues about how the global monetary system may evolve. A sudden collapse of the U.S. dollar would represent one of the most dramatic financial events in modern history. But the dollar's dominance rests on a vast financial architecture that cannot easily be replaced. More likely than a sudden collapse is a gradual evolution of the global monetary system. One where the dollar slowly shares influence with other currencies and with real assets like gold. The bigger question may not be whether the dollar collapses overnight. It may be whether the world eventually moves toward a more multipolar monetary system. If global debt continues rising and geopolitical tensions accelerate efforts to diversify away from dollar assets, could the future of the monetary system look very different from the one we know today? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.